It seems, though, the Aussie share market could seriously continue to outshine US stocks this year. Plus, we cover why you need to watch A2 Milk, Alibaba and Meta. It's great to have your company this Monday, the 17th of February. My name is Jessica Ramir, market strategist here with Mumu. We've seen US stocks prove they're resilient, not only breaking new records last week, but also with the S&P 500 charging up 1.5%, the Nasdaq up 2.5%. This is all despite hotter than expected inflation data and sluggish retail sales. Basically, this proves investors are seriously squarely focused on company fundamentals, and that is stellar company profit results and outlooks. And we've seen that come through from 77% of the S&P 500 companies that have reported so far. And this is why we're seeing, ladies and gentlemen, stocks hold at record all-time highs. But this week, it's Australia's turn if we'll see the market stay in record all-time high territory. The futures earlier were suggesting a 0.6% decline on Monday in early trade. That is following the sputter that we saw on US stocks on Friday. But the real focus and the direction will come from the RBA's expected interest rate cut tomorrow, along with Aussie share companies in the ASX 200 releasing earnings results. And so far, earnings have been strong. When I say strong, we've seen 60 of the ASX 200 companies report 11% better than expected results, and that's what's keeping the market afloat. But tomorrow is the key deciding moment for where Australia's share market could go from here, and if we'll hold at these levels. Now, if the RBA makes that first rate cut, the first rate cut since 2020 tomorrow, as widely expected, remember bets are on for 86% chance of that cut coming to fruition, then the market could hold at these levels or even extend February's 0.3% gain and this year's almost 5% rise. But if we don't see that, then the market will face serious pressure tomorrow. Also consider this, not only is the Aussie share market outperforming US stocks this year, but we're probably going to see commodity stocks break higher and pack a punch because China is expected to pick up demand. And remember, this usually happens around this time of year, ramping up in March into April. Let's get to some stocks that you need to be across today. A2 Milk has just reported results. Its second highest revenue in history, 892.8 million NZ dollars. That was a half-year result. So basically, to put it in context, that was 10% up on the prior corresponding period and about 3% better than the market was expected. So tick, tick, tick. Now, this is all thanks to China sales growing despite the overall infant formula milk shrinking. So this company is proving it's nimble and it's adjusted its business models and it's defying the odds. It's pretty resilient in itself. The company also increased their guidance for the year ahead. They're seeing stronger sales in other regions, which is wonderful news for long-term shareholders, given their shares have been doing a doozy. You can see that their shares have been in the doldrums, but bets are now on for A2 Milk to alley-oop, just on the back of this stronger than expected guidance, in particular for the English label formula, and also increased milk sales likely to come from the US. Changing pace to Alibaba. This is a darling that we spoke about last week. Now, Alibaba shares on watch for two key reasons. Reason one is this, their shares they look like a rocket ship. They're up about 60% in a month. Let's call it 56% for those who know the numbers and cents. So their shares have been charging not on the back of DeepSync's launch, but Alibaba's launched their own AI model. We've been speaking about that. Secondly, Alibaba is in focus this week because they're due to have a show me moment. And what I mean by that is their earnings results out on Thursday. That's US time. They're expected to show record revenue of $277.4 billion US dollars. That's partial thanks to sales volumes hitting records from China's Singles Day. But also focus will be on Alibaba's AI model. Apologies, I don't know how to pronounce the Chinese name of that model. But focus is on the outlook of that, details of the new AI model, and who is going to be buying that. And also, what does spending look like for this AI model? And last but not least, what is the company planning And will it be hit by the US tariffs on small packages from Chinese sellers to American buyers? That is a very key consideration. But all in all, many are betting that their shares will continue to move higher, perhaps on a record result. Changing pace to Meta. Meta should be on your radar for a couple of reasons. Their shares have been going parabolic. They're now up for an outstanding 20 straight days of gains. It's a record for any stock that we've seen in history in the S&P 500. Also worthwhile noting, well done to you if you've been invested. Their shares are up almost 30% this year, up 26% if you want the actual numbers. Look, not only is Meta planning on investing big in AI products, but specifically over the last couple of days, they've announced that they're going to go big on an AI-powered humanoid robot. Plus, they're also ramping up their focus on their smart glasses that are selling like hotcakes in the US. I've not seen anyone in Australia buy their Meta glasses, but in the US, sales are roaring. But look, Meta shares should be on your radar. They're obviously due for a pullback. They're in overbought territory. What I mean by that is they've got an overbought reading of 82. And the last time Meta had a reading of overbought at 80, Meta shares then fell 8.2%, but then they recovered and then hit new record high after record all-time high. So you could have an opportunity, if we see Meta shares pulling back, you could have an opportunity to buy them in the pullback. Of course, no stock goes up in a straight line. That's something for you to consider. For more information on stocks we've mentioned today, head over to Moomoo. It's great to have your company. Let's have an amazing week.